Era assim que o brasileiro via o mercado financeiro. Uma escuridão total. Foi aí que, em um pequeno escritório, a XP abriu suas portas. E ao ligar a luz, acendeu muito mais que o espaço de 25 metros quadrados. Iluminou o caminho para os investimentos além dos bancos. 2011. Chegava o momento de compartilhar o que a gente havia aprendido. Nascia a Expert XP. Ano a ano, seguimos investindo em conteúdo. O brasileiro crescendo em conhecimento. E assim, transformamos o futuro. Já somos milhões de mentes acesas, com muito mais clareza em nossas escolhas. Tornamos o conhecimento acessível a todos. E estamos apenas no começo. Bem-vindo à Expert XP 2021, o maior festival sobre investimento do mundo.
Olá, olá! Oi, pessoal! Sejam muito bem-vindos, muito bem-vindas à nossa Expert XP 2021. E aqui a gente acredita que investir no conhecimento transforma o futuro. Então, aqui no Palco Parceiros, o que a gente traz para vocês são conteúdos diversificados, preparados pelos nossos patrocinadores com temas atuais, conteúdos ao vivo e on demand. Então vem com a gente. Eu sou a Mônica Iose e vale muito a pena dar uma voltinha para ver tudo que a gente tem por aqui. Aproveita também para conhecer a nossa cidade digital, como não? Onde você encontra a programação completa de todos os palcos. São 6 no total, cada um com uma atração diferente. Além dessas entradas ao vivo, são mais de 50 conteúdos que os nossos parceiros desenvolveram especialmente para vocês. Mas vamos logo ao que interessa, minha gente? Os nossos parceiros da Jupiter Asset Management, que entendem absolutamente tudo de investimentos no mercado europeu, prepararam uma verdadeira aula sobre o assunto Novo Crescimento do Velho Mundo. E quem vai destrinchar esse tema é o Fund Manager Phil McCartney. Participa lá do nosso chat, deixa o seu comentário, faça suas perguntas e aproveite.
So, hello, good afternoon. My name is Philip Dexheimer. I am head of asset allocation at XP Asset Management, and I am the manager of the DNA fund. I'm here today with Phil McCartney, so we can explore a little more of the investment philosophy of the firm, know a little bit of Phil, and talk about how to invest in new and what are the opportunities and trade-offs that we face there. To start, I would say Jupiter is a highly specialized management firm focused on high conviction, active management. The firm was founded and is based in London in 1985, and they have a lot of different vehicles. One of the largest is the European fund that Phil here oversees. The fund has about 7 billion pounds, which translates to about 50 billion reais under assets. And Jupiter is even listed on the London Stock Exchange and has over 550 employees in 21 different strategies. Since March, the European fund, the European Growth Fund, is in the XP platform, and Phil is here to tell us a little bit of his over 15-year career in long only and long short products focused on the European market. Phil, could you please, hi, welcome, and would you like to talk a little about yourself?
Sure. Thank you for the introduction, Felipe. It's a pleasure to be here today to kind of take you through, the European market and kind of what I'm kind of interested in. So as you say, my career kind of spans 15 years, kind of two global downturns, one financial related, one obviously pandemic related. And I guess across that experience, I worked for a number of years in European long short, which was kind of where I kind of cut my teeth before kind of transferring to more long only style investing here in Europe. So it's been a wonderful learning curve. Again, taking some of those skills that I learned in the kind of long short world and transferring that to long only investing. Europe as a place to kind of look to invest as an active manager, as someone wanting to learn the industry and grow and kind of thrive in. It's been a great hunting ground for me over those years, and hopefully for a number of years to come here at Jupiter. So it's something that I'm very passionate about. I feel very au fait with. It's something that I like to talk about and learn about. My original training was actually in engineering. I wasn't necessarily bound for a path of fund management. I found my way into the city here in London and kind of haven't looked back since then. So it's a pleasure again, like I say, to be here today to kind of take you through what we do here in Jupiter and to talk a bit about Europe.
Great. And I think the start of our conversation is a lot of people, when they think about technology or the frontier or investment in sexy firms, they think a lot about the US and they think a lot about Asia, especially China and Taiwan. But I think that the pandemic has shown us like a lot of the manufacturers of the new, for example, RNA vaccines are settled in Europe. It's in the Moderna, BioNTech, etc. So what would you tell our spectators here about the opportunities and, let's say, to go against the view that Europe is a sleepy continent?
Yeah, and I think that's kind of the impression that probably most people looking in from outside of Europe have of the territory itself. It kind of comes across as that kind of stuck in the middle between two quite giant, what you would call economic superpowers in their own right. And a lot of focus goes on to US tech or Asian growth. But actually, when you look at Europe, I think one of the defining factors within the European market is the heritage of some of these businesses that we invest in and that we look at. So Europe has a very, very long heritage of businesses, whether that be in luxury goods, it might be in healthcare, as kind of has come to the fore today. It can be in consumer goods as well. But it also, when you look at it, goes through to a lot of kind of manufacturing businesses that and products that you kind of maybe don't take that much notice of. I think of like a lock business, for instance, called Assa Abloy, that was kind of formed in the late 1800s, is in a lot of people's doors today and is on the cutting edge of kind of digitalization. So, we find businesses like this all the time in Europe that have built that history over that length of time. I think the other thing to note about Europe is the corporate governance structure. Despite, obviously, with there's a lot of column inches written by journalists about the European construct and the political construct. Actually, it's a relatively stable governance regime. And, we've seen governments around the world repatriate capital or, at the expense of shareholders and other stakeholders. And actually, Europe, from that perspective, you're quite well protected by the laws that bind this region. So again, it's another quite a safe place, relatively safe place for investors to put their capital in. I think the other interesting thing is just, as you say, some of these businesses, they whilst being extremely old, are right on the cutting edge of what they do. So, you mentioned the Moderna vaccine. One of our portfolio companies is responsible for the outsourced production, of that of the vaccine that's kind of leading us out of this pandemic, and that's a company called Lonza that was formed in 1897 in the Swiss Alps. So if you think about it, over 100 years old, could be perceived as quite an old, sleepy company, is actually at the very forefront of the cutting edge of drug development and drug production, as we see today. So I think it's those attributes that we see in Europe that lend itself very well for investors. If you think as well about the environmental leadership that Europe is bringing to the fore today, a lot of the ESG factors that we might talk about in a bit are being led by Europe and by European companies, and actually they're at the forefront of some of these environmental changes that are going on that the rest of the world is looking at to see how they evolve. So I think Europe's got some great attributes that go hand in hand with global growth and above average global growth that kind of show that why it can beat a lot of the companies that we see maybe in the US and Asia that get a lot more column inches than Europe.
Yeah, I think it's really important what you've said about corporate governance. People tend not to remember corporate governance and the importance it has until something goes wrong. And we've seen the institutional difference between Europe and East Asia. We saw in recent weeks what a little too much interference can do to a sector or a whole stock market. Even here in Brazil, we're not protected by this. In 2015, our then president interfered in the utility sector, the generation of electricity, etc., and it also caused a turmoil in the stocks in this sector. So it's a little, perhaps it comes with age. So in Europe, the press is free, the voters are conscious, and they have savings in equities as well as fixed income. And this makes a powerful combination in terms of governance. And I would like to say, you talked about the ESG. There's a lot of also of these same voters and investors in Europe are at the forefront of worries about sustainability and climate change and everything. And this makes these companies more reliable, even when they sell products abroad. So I think it's a very important combination and a very solid combination.
Yeah, I tend to agree. I think again, Europe's known for it can be known for its bureaucracy and its kind of the regulatory framework that it sets out. But I think that is why the businesses that we see in Europe today are leading in these environmental, social, and governance factors, and I think that stands them in very good stead, as global businesses as well. So it's not just the European market that wants ESG factors or companies leading in their respective fields. It's the customers of those businesses in the likes of the US or Asia that also want to see companies with those high environmental, social, and governance standards. And I think that's why Europe in that regard is very well placed with regards to that globally.
Yeah, and perhaps some things do come with age. For example, the luxury sector, that people can buy a handbag with 100 years of history, positioned as a luxury market. It compounds the value of the stocks, and it's that Louis Vuitton is the biggest luxury company in the world today. And I think it's one of the opportunities, but I would like to tell us a little more what will come in the next 10 years, thinking of sectors and perhaps companies in Europe.
Well, so I think you've raised a very interesting point about luxury companies and their heritage, but also just in terms of the growth of that looking forward, not just from an Asian perspective, but also from a global perspective, as as middle classes get more wealthy, and actually luxury has become a bit more democratized, across the world. So I think they're extremely well placed still for the next decade of growth ahead of them. And it's interesting. I looked at a handbag that Louis Vuitton actually created in the 60s. You can actually still buy the same handbag today. And if you look at the price inflation over that kind of 60 or 70 year period, it's kind of a 6% per annum price inflation growth rate, which is far inflation beating on any global scale. So again, it just shows the pricing power of these brands that they have, on a very long-term time frame. And I don't think that's going to necessarily change in the next 10 years. Another great theme that I think Europe is extremely well exposed to is the digitalization and the digital agenda that obviously we've all embraced in the last 18 to 24 months as we've gone through this pandemic. We're using much more technology, more hardware, more computers, more software, and we look at companies in that sphere. The likes of ASML, is one of Europe's biggest companies. It's probably not a company a lot of people outside of Europe have heard of. What does ASML do? It's the global leader. It's actually the dominant global leader. It's got a market share in the high 80s, if not 90s, in terms of its EUV machine, which is the machine that is required to make semiconductors. So that's the only company in the world that can produce this machine, that can deliver us the tech that we want to put on our wrists or in our pockets or in our screens in front of us. And I think, when we look at the rise of digitalization and the power of technology over the next decade, I think the pandemic has shown the use of that and why we're going to be using more semiconductors. So ASML is extremely well placed in that regard for the demand of its equipment over the next certainly next decade, even not the next few decades. And again, that's somewhere where, again, a European company, set up in 1970 in a lab in Eindhoven, that is now the global leader in semiconductor manufacturing equipment. So again, it's another example of a European company that has got heritage, investment behind it, an extremely well invested business, and a very substantial brand equity in its respective market, with a great leadership over its competitors. So, those moats are what we are looking for in what we look to invest.
And how do you take disruption into account? Can these companies be disrupted all of a sudden?
So I think disruption is something that's kind of been with us since the dawn of time. If you put yourself in the shoes of a horse and cart maker in the 1900s, and this guy Henry Ford turns up with what looks like a four-wheeled vehicle with an engine in it, they probably laughed at him back then and thought, well, how can you destroy our industry? And yet 20 years later, we're all driving around in motor cars. So we have to be aware that there's always disruption on the horizon from every industry. And what we look for in our investments is certainly for the disruptive factors and what they might, how they attack the barriers or the moats that are around our various businesses. But we're also looking for businesses to disrupt themselves. They should be innovating. They should be leading. They should be the leading edge of what they're bringing to the market in terms of trying to disrupt themselves and with their leading edge products. So, we think about data companies and the way that they analyze data and trying to build smarter algorithms that are smarter than the last algorithms that they sold to the customer. Because ultimately, if they don't come up with it, then potentially somebody else does. So by disrupting their own business, they're actually driving growth in their own business going forward and stopping the competition entering. So again, I think disruptive factors are kind of here to stay. I think, when we look at QE and the role that money's played, I think that means that there's a lot of businesses out there that have driven disruption across various aspects of industry. And that's why it's extremely important to find those investments that have competitive moats, competitive edges, ability to basically have pricing power with their customers over time and allow themselves to grow at a healthy rate above their industry.
Yes. And how do you, I'm going to postpone this question, but what is important to say in this regard is a lot of people, especially outside of Brazil, Brazil is still a region where active managers can beat the index and generate alpha. And a lot of people, when looking abroad, take a US-centric view, where we've seen for years the S&Ps and Nasdaqs leaving the active managers behind. But what I would like to add is Europe is not so simple. And active management there still generates alpha, generates excess returns, and with an ESG touch. So I would like to ask you, how do you build your philosophy? How do you build a fund then to catch this European growth?
Sure. So, first and foremost here at Jupiter, we are what we would describe quality growth investors. That's kind of what we're about here, with a very long-term perspective and a long-term holding period. So I think, again, as an active manager, many people think about active managers, and I've seen this in my previous, existence in long, short worlds, lots of trading, lots of activity. Actually, we like to think actively and act lazy. That's kind of the role we believe of a good fund manager in Europe. So the European index, or the European kind of pot of stocks that we can invest in, is somewhere in the region of 1,500 to 1,600 stocks, which is a lot. If there's a lot of stocks to invest in, and clearly you could take a passive strategy and you could invest in Europe on that basis. But my pushback to that has always been that if you own a passive fund, you also expose yourself to poor operational performance, poor financial performance, potentially poor ESG factors, potentially disruption, and actually potentially quite poor companies in regards to where they sit within their respective markets. So an active approach is able to optimize all of those factors. So roughly from those 1,600 odd stocks that we look at, we like to distill that into a portfolio of about 40. Breaking down that cohort of companies by looking at market structures, looking at market positions, looking at respective growth rates, looking at the trend of growth and what's kind of driving the growth rates of companies in order to establish, which companies we can invest in. So, we like to say that we're macro aware, but not macro driven. We're very agnostic here at Jupiter as to sectors or even the benchmark. We're just simply trying to find the 40 best companies in Europe to invest in. And we believe that by being here on the ground with an experienced team around me, so I have there's a team of 5 of us that work on these funds, with around about 60 years in total of experience. That's a vast number of years in the European market for us to be looking at. It's that experience that's allowing us to go and search out for those companies that we believe over the next 10 to 15 years will thrive in the European market. So again, the overlooked nature of Europe, back to our first question, as people kind of overlook Europe because of, a focus on the US or on Asia, allows us to buy a lot of these companies at discounts to their global peers, despite often having better market positions, often better operational aspects to their profitability, to their returns, to their cash flow, and often better growth prospects because of the investment they've done in their business. So we look to distill that down into a portfolio. We have a lot of debate here at Jupiter. One of the good things about Jupiter is that we work at a reasonably what I would describe as a mid-size organization, but that allows you to have the freedom to simply invest. There's less bureaucracy at a big organization. And I think that allows us as fund managers, as analysts, that's what I kind of see myself as to really delve deep and understand my businesses as kind of the first line of defense in risk management. Because ultimately, if I can find a business that I believe can compound growth over time, then as a fund manager, I don't have to do a lot other than just own it. It's kind of, it will look after itself. So, Europe is a perfect hunting ground for active managers from that perspective. It often gets buffeted by the macro. It gets buffeted by political, political discord that might happen. We think about the Brexit vote, etc. And those are just great opportunities for us as active managers to pick up businesses at very good prices in the portfolio. So again, I think we mustn't forget that Europe is a market that has a lot of founder and entrepreneur-led businesses. There's a lot of capital invested behind these businesses, and we're looking for those businesses as well that still have the founder or the entrepreneur involved, because ultimately you know that your capital will get looked after and investment decisions are made in best interest. So again, that's why I believe you can make more alpha in a European context than you might be able to in the US, where, you know, if you buy an S&P fund, you're taking a big tech bet ultimately at the minute, certainly in the US. So you better know those 5 or 6 companies very well. But again, you're quite concentrated in the returns that you make within those companies. So again, Europe gives us that potential to play lots of different themes in a very active way.
And what would you say are the main themes today at your portfolio? We've talked about a little about luxury, microchips, and pharmaceuticals. Are these themes in your portfolio? What are other themes do you see, and what do you think are their growth drivers?
Yeah, so I think there's several other themes to kind of pick out from that trend. And we talked about digitalization. I think aging populations is another one. You know, we're kind of getting older, and as healthcare improves, you know, we're living longer lives, and what does that mean for healthcare going forward? Often, you know, healthcare systems simply aren't built for that kind of need that comes from older generations. So we're going to see a lot more home care, a lot more self-care, as it were. And I think that plays very well into testing and diagnostics. So, you know, we look at some of these testing and diagnostic companies that are in Europe that are kind of world leading in their field. They have, you know, market shares that are enviable to their competitors in their respective tests. And you know, it can be a sell and repeat business model. You know, they put the machine into the pharmacy. You go and get tested. And they need to sell consumables to be able to do that. So it's a very repeatable type of business. And companies like a Diasorin or a Eurofins play very well into that regard. And obviously we've seen a lot of that with COVID, and there's been an acceleration in the diagnostics market as we've all tried to get tested for COVID. But those machines are now installed in their setting. And so they're able to, we've kind of accelerated the healthcare transition in that regard by making that capital investment. Government's made that capital investment over the last 12 to 18 months. And I think that bodes very well for those sorts of businesses. I think environmental, you know, as we've touched on, is a very key source of growth as well. So, you know, we look at some companies that are in the building sector. So buildings generate around about 40% of greenhouse gas emissions. It's not cars, it's not planes, it's not boats, it's buildings. You know, the heat loss that comes from those, or the likes of having to air condition buildings to keep them cool, to have people in. And so we've got companies, you know, in Europe that are the world leading businesses in, say, insulation, a business called Kingspan, and it's selling its insulation globally. It's a business from Ireland. And this business, you know, its insulation products are vastly ahead of the competition. They are taking market share from competitors that haven't been able to invest. And as they get bigger, they invest more dollars back into their business to create more cutting edge products. And these things are now being designed in by architects when previously the architect deferred that decision to the building manager. So Kingspan is actually being specified by by architects and building owners in order to keep their green credentials. So again, finding businesses that have an environmental edge and that have pricing power and good market positions allows us to play that environmental theme, which we think has got, you know, years to grow in terms of the life ahead of it. So, you know, a lot of our businesses, it's not just one or two themes that they're exposed to. They're often exposed to quite a few of these themes. If you think about digitalization, actually proliferates quite a lot of this. But, you know, those I would pick out as some of the main themes that kind of proliferate through the portfolio.
No, it's great. And just so people get a little more intimate with the fund, you've talked about 40 names. How are these 40 different stocks divided? Is it a concentrated portfolio or a diversified portfolio?
So I mean, we would describe that as quite concentrated, certainly in the European context, given that you know, we can own 1,560 other stocks in the market. So we tend to run a very concentrated portfolio. The top 10 names are roughly 50% of what we run. So we like to run quite a high conviction portfolio. And it's also got a relatively low turnover. As I said earlier, you know, we We look to think actively. So we're constantly debating, what's the best names to own, in the market? Where is the next growth opportunity? We meet a lot of companies here in London and in Jupiter. We're fortunate enough to have great access to some of the leading management teams in Europe, and that gives us a real insight into what's going on in the business world. So, we like to have that competition for capital as well in the portfolio, and that results in churn in the portfolio. So we kind of churn maybe 3 or 4 names a year. That's probably our maximum churn. So again, it's this thinking actively, doing a lot of detailed work and really trying to understand the markets that the business operates in, what drives the cash flows, what drives the returns, what drives the sustainability of those returns, which I think is ultimately very important. So, far too often, investors in public markets, they fed the returns and they fed the growth far too quickly, which results in shares being underappreciative of their prospects. And it's our job to think as active managers, what do the next 3-5 years look like? That's somewhere the computers haven't got to yet. They can trade in milliseconds, they can trade in microseconds, and we're not going to win in that game. But if we think about the next 3 and 5 years, using our experience, using all of the know-how that we have from the European market, what we look for, the management team relationships that we have, we believe that we have an edge over the computers in that regard. So again, that's how we try to construct the portfolio here. Really try and concentrate our bets into those top 10 or 12 names that sit within it, giving us a bang for our buck at any one time. And also, if you look at the sectors, again we're quite agnostic to the sector exposures. So, there's some industries that we don't invest in, basically because of the competitive nature, the regulatory nature. So if you think about a utility firm, for instance, your return is basically denoted by the government. So you can't really earn more than a 7% return because that's what the government says. And so, for an active investor, that's not very exciting. So, we tend to be underweight those kind of sectors. Banks, another very competitive market, in Europe, very commoditized market in kind of what they sell. So again, a difficult industry for us to get our head around, because we're looking for those businesses, those industries that can develop value over time, that can continue to invest and build products that people want, and people will pay up for. Ultimately, that's what we're looking for, that pricing power of a business that comes through brand or IP or product.
Yeah, that is where you should look for growth. And I think you're not wrong. And could you tell us a little bit about an investment case where that took its cost, it didn't work as well as you would like, and another one what it perhaps worked better than you've hoped?
Yeah, sure. So I think what I would pick out from that, if we kind of focus on something where it's kind of been a bit of a struggle or it's been a bit difficult and we've kind of pulled back, there was a business in an exchanges that was, it's got great market shares and what it does, and it looks like it's got some very good positioning, but it's a business that was failing to invest in itself, and as it invested in it, it kind of wasn't investing necessarily in the areas that we thought it should be investing in, and that kind of made it a bit difficult for the growth rates that were coming out of the business. And as those growth rates faded, they began to look at trying to maximize their earnings by other means. So looking like kind of recognizing gains on investments or things that aren't really organic. And ultimately, that kind of shows up in the organic growth rates of the business as it begins to fade. So, that's an investment where, we didn't lose, a huge amount of capital on it. It's something that, it might still work out. But for us, the way that they were investing, the way that they were looking at the market, the way that they were treating the cash that they were generating didn't seem very appropriate, and actually is kind of opening up potential disruption to their market. So that was a business that we took off the table. We moved on. We kind of got that wrong in terms of assessing how management were able to allocate capital. I would say on the other side of things, as a success story, I'd go back to ASML, a business that we've owned for a decade. It's a business that's done extremely well for us, and it was a business that 10 years ago was rated at kind of 20 euros in the depths of the financial crisis in 2008. It was sold very, very heavily down as a business that was maybe under a bit of pressure. People weren't buying semiconductor equipment. It looked like chip companies were really going to struggle. And yet here was this business that had 40 years of investment behind it. It was on the leading edge of semi-capital equipment. Semi-capital equipment. It's the only business that can deliver the machine that makes chips. And if we'd had the launch of the iPhone, we'd understood that computers were proliferating everywhere. That seems like quite a good industry to be involved in. So again, making an investment back then was quite a sensible thing to do. We thought the prospects of the business looked good, and never in our kind of wildest dreams did we actually think the demand for semiconductors would explode the way it has done a decade on, and what we've seen in the pandemic. So, there's also a bit of luck involved with that, but I think the assessment of the business, assessing that the management team were allocating capital effectively, that they were spending their excess cash in R&D and developing the next machine, that they had good social governance factors around them, that they were benefiting the environment, that they were beating their competition, that they were taking market share. All of that kind of played out. And ultimately, the growth rate picked up meaningfully, and the market very much underappreciated that. And the shares have gone up meaningfully since then. So to become one of Europe's biggest companies. So that, again, I think is an example of how at Jupiter, we like to think about long-term investing, trying to pick our moment when there's volatility, when there is, when the market kind of potentially loses their mind a bit, and trying to stay calm as active investors, backing our work, backing our debate, and ultimately taking a long-term view and investment in a world-leading business.
That's great. And so that you who is watching us can understand what this leads to. This leads to a strategy that has, over the 10 plus years that they've carried the SML company, for example, the strategy delivered returns of about 14% per year in euros, which is 6 or 7% above the index, and on an annual basis. That means you will double your capital 10 years earlier than you would double your capital if you were invested in the index, roughly so. And we can see that how they focus their portfolio, a concentrated portfolio. They make mistakes, but the gains you make from companies that enter a sustainable growth track, it's much greater. And one question, which is actually very important, not only for me, but for who sees us in the XP is taking the lead in environmentally friendly investments, and it's we are embracing that at the core of our culture. And I would like to see, how do you see it? How do you embrace that in the funds management, and how do you think that leads to or doesn't lead, but how do you think that leads to better returns?
So there's a load of things there, and I think it's really worth discussing, because I think the philosophy and the way that we look to invest with a quality growth bias lends itself very well to ESG scores that the companies can generate and are leading. And I think there's lots of different reasons for that. But before I go into that, it's worth mentioning that here at Jupiter we've got a very strong team of ESG analysts that help us as fund managers assess those risks. They're specialists in their respective fields, and they're very helpful when it comes to assessing a new position in the portfolio, or the engagement that we have that is ongoing with our portfolio companies. So again, that's worth mentioning too, which is, last year of our 40 portfolio companies, we actively voted in all 40. So, we don't use the computer, we don't use the box ticking exercise. It's very, very much fund manager led. We look to make decisions based on our assessment of the business's capabilities, the business's performance, and the business's presentation of their E, S, and G factors. So I think it's worth noting that here we take that active approach, because we believe that leads to better outcomes over the medium term. So just touching on that environmental aspect, I think one of the things that is quite key today is when you're thinking about an investment, think about the end customer. What does the end customer ultimately want from their business that they're buying from? So whether that might be in luxury, so it might be the end customer in the luxury goods shop, or it might be the person at the bar, or it might be the person who's ordering a lock or a diagnostic machine for their pharmacy, right? But ultimately, they're all end customers. What are they looking for? They're looking for responsible investment from their partner companies, from the companies that they're buying from. And the good companies that are out there have realized that. They have realized that there not only is there a societal benefit to being leading in E, S, and G factors, but there's also a benefit commercially to be able to do that. And that comes in two guises. And I think it's worth noting this is that, one, if your business can lead from an E, S, and G perspective, you can take market share. So you've got outsized growth. So your growth is higher than the market. You're going to be growing faster. You're going to be getting more revenue. More revenue is more money to invest. More money to invest means you can build bigger moats. It means you can defeat the competition. It means you can create bigger gaps. It means you can develop the next best product. It means you can develop the next thing for the customer to want, and your growth becomes quite circular. I think that's very important to realize why we believe that quality companies are doing that at the forefront. The second aspect of that is the cost. So as governments and as people, people more generally focus on E, S, and G factors, that's going to raise the bar for the cost of your product. So that means that if you're a poor business with low margins and low growth, because don't forget you're losing growth because the people that are good at ESG are taking it from you, you're going to get a very negative squeeze on your margins. And ultimately that means less cash flow to invest, and you're going to lose your position in the market. So I think, again, looking at quality businesses that are able to have pricing power and able to pass that back to the consumer to maintain their margin, to pass on. And if you're not up with the ESG agenda or with the standards, you're going to get penalized. We think about the car companies and the penalization that they get from having carbon in their fleet, and the amount of money that's cost shareholders ultimately from having to invest or pay out in fines. It's mind-blowing. So that's money that could have been used to get ahead of the curve, but they've had to give it to the government because they're far behind. So quality investing actually is lends itself very well to these ESG scores. And when I look through our portfolio, our portfolio companies score very well on that basis. And it's something that we talk a lot about with the companies, how they're assessing, their environmental, social, and governance factors, how they're marking them, but also how they're thinking about investing behind them and using the capital to not only lend itself to stakeholders, but also for commercial success. So we're seeing that, we think about, businesses that generate wind turbines, or they might generate batteries or technologies that we're not convinced, yes, they're green, but they might be commoditized in the long run. We're not sure what the edge is in those. So we much prefer our businesses to have a competitive edge and also be giving those environmental, social, and governance factors to their customers to keep that edge over their competition.
How often do you say no to an investment opportunity based on failing this environmental, government, and sustainability?
Very much so. So all of our investments go through our proprietary process here at Jupiter, where we take a very quantitative look at the factors, but also a very qualitative look at the factors. And we will not invest in something if we believe that there's a chink in any one of those three factors around them. So we think about obvious companies that we won't invest in. Extractive industries, coal. Not only is it not great for the environment, it's dying out. It is being disincentivized by governments globally as they look to clean up, their atmospheres, and it's part of the getting to the kind of the 2 degrees that we see, the global compact's striving towards. So again, not only is it's not a social way to invest in say mining, but also it's not a commercial way to invest either. It's not where we see the best growth prospects going forward. So we can look at the best business in a certain sector that might have a great market share. I think a lot about tobacco companies in that respect, but ultimately, what they do harms their customer. It's ultimately, it's not something that customers want to get involved in anymore. It's a volume declining environment, and that is ultimately a very tough place to be. And so it's not somewhere where we'll look to invest.
Yeah, it's great, and we all need the planet for ourselves and for our children. So it's self-defeating if you try to avoid this discussion, even when building, especially when building a long-term portfolio. And one thing we've not talked about is country allocation. We've talked about Europe. It's fragmented in a lot of different countries with, I must add, a population of over 500 million people and GDP that rivals the US. But how do you pick these countries? How does this enter your governance? And I would like to ask also, where does Europe end for you? What would you make? Should I invest in this country, yes or no? Is there a factor that says, okay, this country has a too poor governance perhaps for me to invest? Where do you draw the line?
Yeah, that's a very good question. And I think you're right. Europe is made up of a plethora of different countries, different governments. But ultimately, EU law that binds the EU is kind of where we would describe our hunting ground. So that's kind of where we would draw the line. We find it difficult to go into what I would call frontier economies on that basis, mainly because of, as we discussed earlier, it's possible for regime change, it's possible for protection of shareholder rights and shareholder capital, that can get ripped up in an instant. It's possible that those governments are also, financially quite poor with the way that they allocate capital. So that's kind of where we draw the line. We think about the EU as kind of the hunting ground as a country basis. But when it comes down to it, ultimately, I don't really care what country the stock or the business is incorporated in, what stock market it sits on. We've got various different bourses here in Europe, but I don't really care where it's quoted. All I really care about is its growth prospects, its competitive advantages, the way that the management team are allocating capital, what's going to be sustained in that, and then looking at is that priced into the stock or not, and should we own it for the long run. So ultimately, we're very country agnostic as well as being sector and benchmark agnostic in our portfolio here at Jupiter. And so the country, there's lots of nuances, let's say, right? We kind of understand the nuances of the country, and I think that's something that you really only understand sitting here in Europe itself and really trying to get to grips with maybe the different dialects or potentially the different nuances in language and the way that they describe something. And so that can be quite a nice hunting ground as well as a local investor in Europe is trying to find that and hunt that out. But it comes down to ultimately, what does the business look like? Financial language is a great leveler. We can all speak in numbers. We don't necessarily need to speak the language to understand whether the business is a good one or a bad one. It ultimately comes out in the P&L, balance sheet, and cash flow that these businesses report, and that can take us anywhere within the EU construct. So we own businesses from probably most European countries, but we don't own it because it's in the country. We own it because we think it's a great global business that's got great global franchise and great global prospects.
Yeah, good. And as you've said, global. I think a lot of people don't have in mind how global is the footprint of European companies. So for your top teams or top holdings, or perhaps for the whole portfolio, how much of revenues or other measures come from around the globe and not from Europe? But translating that, when you're investing in Europe, you're not really confined to the drawing map with the boots under it. You're actually making a global investment.
Yeah, very much so. So a lot of these companies, they were founded locally, but they're very much exposed globally, right? And what they've done is they proved their business model in a local market and then expanded it to the global work. So, roughly speaking, I would say we're kind of 25-30% of our revenues from our companies come from Europe, and I don't think that's going to be any different. So that means that 70% come from elsewhere, and over time, I think more and more revenue is going to come from the East as our companies make more inroads there. But it's interesting. I was looking just today at a company, Pernod Ricard, which we all know the brands that Pernod Ricard have. Pernod was actually formed in the early 1800s. And it was a drink in France that was invented in 1806. And that is now a drink that is drunk globally, around the world, and it kind of has led to that global expansion and has allowed the Pernod Ricard as a business to expand off that distribution platform. So, taking that example a bit further, in China, 2% of the spirits that are drunk in China are Western spirits. So that leaves 98% of the market to get westernized, in a country such as China. And within that 2%, Pernod Ricard is actually the leader in terms of market share with its brand Martell. So if we think about, a very historic company, kind of 200 years old, formed from France, quoted in France, seen as quite a sleepy company, actually the runway for growth from that business by expanding into the likes of India and China over the next 10, 15, 20 years, the runway there is really big. And I just think, don't overlook European companies from their perspective to execute on those global growth and kind of growing demographic trends that we see in Asia and in Americas. So I think it's a really good point to make, is that, these businesses are global in their footprint. Again, another great example is quoted in London, actually, is Experian that we own. But Experian's two biggest businesses are in the US and Brazil. In fact, it's got 2% of revenues coming from the UK. So it's actually a very, very global business quoted on the UK market that's growing. Experian's business is about data capture, and it's growing in high single digits. So again, another great exposed business.
You talked about, did this stock become discounted during Brexit?
So that's a very good point. So yes, it did actually, and was a great opportunity as active managers to buy into it. So, the UK market obviously got hit very hard by Brexit in the short run, and UK investments were overlooked. And yet within that UK market, as we look at, there's actually some world-class global businesses. So, Experian being one of them, and we use that opportunity where Experian's got a couple of US quoted peers, and Experian's often traded at a premium because of its exposure to Brazil and the opening up of the Brazilian economy and the credit environment that Cereza is exposed to, a brand name hopefully you've heard of, in Brazil. But actually it began to trade at a discount to its US peers, despite having better growth prospects, better profitability, and arguably a more sound financial structure. So that, again, is another great example of where potentially capital flows and an overlooked nature or a kind of macro perspective has given active managers in Europe a real opportunity to own great businesses at very reasonable prices.
No, it's amazing. And well, we're arriving at the end, the final 5 minutes. I'm going to say a sentence that I keep saying to our investors, which a lot of people tend to associate investments outside of Brazil with, I don't know, they are for rich people. Like an investment outside of Brazil is like a BMW, high end. No, it's not for me, but I would say otherwise. I keep joking that investing outside of Brazil or not to invest outside of Brazil is like going on a bookstore and not looking at the foreign books. So, okay, there are great writers in Brazil, etc., but you're overlooking from Shakespeare to Ken Follett if you do not visit. And thanks to the great platform that XP has built, all these investments are available with low minimums, no front load, which is a big standard, and accessible to all investors who, I think, and in the DNA funds we hold today a position in Europe, they should own part of their portfolio in these histories, and your vehicle is great for that. Well, do you have any final remarks?
So it's kind of interesting that you talk about that, because being expensive. So I guess one of my biggest learnings, I think, through my career as in long short has been often if something is cheap, it's probably pretty cheap for a reason. The market's quite efficient on that. So when I think about our businesses and the way that we look at them optically, they look expensive on a near-term view, on a near-term PE basis. But I think that it's the power of compounding. It's the power of sustaining the returns and the growth that these businesses can generate that actually makes them look cheap on a long-term view. And I think those are the kind of investments that you want to be owning. And you make a really good point about being outwardly focused. And I think it's very important to recognize that in Europe specifically, we have got some brilliant global businesses with some great heritage that we're able to invest in, that we're able to get exposure to. And why would you not want to get exposure to the luxury market in the way that you can? Or maybe it's about data and understanding how data is used. We can all understand how much data we're using these days, but why not get exposed to some of those themes that you can only really get exposed to in the European market because of the dominance that we see of the companies that are within that. So we're really looking for those businesses that are able to get exposure to the mega trends, that they have, ultimately they've got a long runway of growth ahead of them, but they're allocating capital effectively. They're run by good management teams. They've got family ownership. They've got great financial sound structure, and ultimately they do the work for us. And I think, Europe has got these businesses in it, and I think it would be remiss not to have a look at Europe and to really look at an active management style in Europe to do that.
Okay, well, that was a great conversation. Thanks a lot, Phil. As we've said in the beginning, Phil's fund is available at the XP platform and for everyone. So thanks a lot for joining us, and the expert will go on.
Thank you, Felipe. Thank you very much for listening.
Thank you.